is there any deposit growth happening? It is not just an arcane issue for bankers like us to discuss. It is actually a macroeconomic problem, because that means that there is not enough money in the economy for transactions to occur. And a very stark way to explain that, it's like, in a fish tank, if you think all of us are fish, and you have those bubbles giving oxygen, right? If because of power failure or something, the bubbles stop forming, the oxygen in the water starts to slow down, and you will see the fish starting to slow down. It is something that will surprise many people. Why is the fish slowing down? Is it sick? Money in that way is kind of like very diffuse but very critical for the functioning of the economy. Our tier 1 ratios, that's a form of capital buffers that we have, has gone from 9 and 10% respectively in FY8 and FY13 to 15%.
It's gone up by 50% basically.
Yes, there is a substantial amount of equity that the banks are sitting on. And the overnight liquidity has now gone into surplus. So the overnight liquidity has been in surplus since about end of June. Given how long this has been in surplus, it is very clear that this is deliberate. It is not accidental. It is not because suddenly government started spending, which has also started to happen. Government cash balances have gone down. If the RBI wanted to, they could have sucked it out. So we are seeing now significant amounts of surplus in the overnight markets. What I think the RBI is signaling to the commercial banks is that, look, I'm going to keep it in surplus, and therefore you can go ahead and start growing your credit again. Given how tight the liquidity was kept for about 1.5 years, I think the banks are still wary that this could be temporary. So despite the fact that the overnight rates have fallen to 6.25, as you know, in the overnight liquidity there is a corridor. There is the repo rate at 6.5, there is the reverse repo at 6.25, and there is an MSF at 6.75, right? So 25 both set. The objective of liquidity management is to keep the overnight rates close to 6.5.
Right.
In the last 2 months, they are actually closer to 6.25. So the RBI, I think, is signaling very strongly, in my view, that they're going to keep it quite relaxed on the liquidity side. Overnight drop in cost of funding has not yet reflected in the 3-month and 12-month borrowing rates for banks coming down. It is when that starts to happen that you will start seeing more demand, and therefore banks become comfortable lending again, and money creation, and the engine restarts.
Hello and welcome to a very interesting episode of Open Dialogue. Over the last many quarters, deposit growth in India has trailed credit growth. Over the last few months, this has become a hot topic. The regulator, the finance minister, many analysts have commented about this. Now, why is deposit growth so important? What results in deposit growth? What implications does it have for the economy? We will discuss all of these topics in today's episode, as well as bust some myths. Joining me today to discuss this is Neelkant Mishra. Neelkant is the chief economist at Axis Bank. He is a well-known figure. Neelkant, thank you for joining us and look forward to this conversation.
Thank you for having me here again.
Before we start, Neelkant, for our audiences, if you're interested in this topic, we've covered many fundamentals of this in 2 previous discussions. The first was on money and the second one was on how banks work. So I'll request you to, if you're interested, to go back and look at those episodes as well. Neelkant, let's start with a couple of myths and talk about them a little bit. The first popular conception is that kind of deposits fund the loans. So the bank takes deposits from a certain set of people and then gives it out at loans to certain other sets of people. So can you shed some light on this, on how this works?
So the reverse is actually true. So it is when loans are given that deposits are created. So,
right.
So suppose Axis Bank gives Sameer Shetty a loan. The second before the loan is given to you, suppose deposits in the system are 100. There is a 5 rupees of loan given. Suddenly there are deposits in your bank account, right? So money. That is how money is created. This is how commercial banks create money. The constraint on how many, so can the banks keep doing it forever? They cannot, right? So there is a certain amount of risk buffer, or say capital, that the banks need to preserve to keep it safe, so that if the loan goes bad, the depositors don't suffer. But the fact is that as much as we are, as banks, tracked on the loan deposit ratio and all that, the reality is that the only real constraint on how much money a bank can lend is how much capital it has.
Right.
Because it can create deposits at will.
Right. So just to exemplify this, let's take a very simplistic situation. Let's imagine a country. This country has only two residents, you and I, and we both have a bank account with one bank. We both have 10,000 rupees in our accounts. So total system deposits are 20,000 rupees. Now, I take a loan and I give it to, or let's say I just take a loan, right? So the bank gives me another 5,000 rupees of as a loan. So in my savings account now there are 15,000 rupees. In your savings account there is 10,000 rupees. In the bank's balance sheet there is a loan of 5,000 and maybe there's something else as well, but now a new loan of 5,000 has been created. But the total deposit in the system went up from 20,000 rupees to 25,000 rupees.
Correct.
And so this is the notion of the loan creating the deposit. Correct. Because every loan that is given, it will go and sit in somebody's account.
Yes.
It may sit with some other bank, like bank X may give a loan, it may become a bank deposit in bank Y. But at the system level, the loan comes first and the deposit comes later.
Usually it will, because the loan that is given is also, to someone who has a bank account there. Now, what you may choose to do once that 5,000 rupees is credited is that make some payment with it to some real estate developer from whom you bought a house, or some car company or whatever, right? And that may go into someone else. But at a system level, whenever this loan is given, money has been created.
Absolutely. And now this is a very fascinating concept. It's actually quite difficult to digest, right? Because conventionally, kind of the mental model that everybody has about banking is that banks take deposits and use them to lend out as loans. But what we are learning from you, Neelkant, is that actually that's not the case. Banks give loans. The act of giving loans creates money and
Correct.
creates a deposit. There are some metrics like this loan deposit ratio or LCR and so on and so forth. Those are more to ensure liquidity, for the depositors.
Yes, and that liquidity for the depositors and to keep the banking system safe.
To keep the banking system safe.
If people do not trust that they will get the money whenever they need it, they will stop giving money into the banking system, and that actually slows down the economy.
Yep.
So one of the things the banks do, and this is where the concept of money multiplier, which we have discussed in the prior episode as well, that today around 1/5 in India, the money multiplier is about 5.3, 5.4. So about 1/5, 1/6 of the money is directly supplied by the central bank. Central bank, like the kings of old, is authorized to give money into the system, and they can print money for free, basically, because they have the sovereign right, and so that piece of paper has 500 rupee value because the government says so or RBI says so. That money is what you call base money, and that sort of goes into the banking system. On top of that, banks then put the money multiplier. So taking that base money, they kind of use their own capital to multiply it, and that then becomes the amount of money that fuels the economy. Meaning that money in the economy is currency in circulation plus deposits. So there's some money that banks place with RBI, plus there are time deposits. So that is the money in the economy which are used for transactions. If it is too little, the economy starts to slow down, which it seems to be doing right now, because there is too little money in the economy. And all of these concerns that we discuss or we see in the newspapers, that is there enough deposit creation happening, or is there any deposit growth happening? It is not just an arcane issue for bankers like us to discuss. It is actually a macroeconomic problem, because that means that there is not enough money in the economy for transactions to occur. And a very stark way to explain that, it's like, in a fish tank, if you think all of us are fish, and you have those bubbles giving oxygen, right? Now, if because of power failure or something, the bubbles stop forming, the oxygen in the water starts to slow down, and you will see the fish starting to slow down. It is something that will surprise many people. Why is the fish slowing down? Is it sick? And then the water power supply comes back, the bubbles start forming. So money in that way is kind of like very diffuse but very critical for the functioning of the economy. So money is created by the central bank or by commercial banks, and it is when banks give loans that deposits are created.
So there are a few things you said, Neelkanth. Just I'll kind of stress just to kind of bring out some concepts. First, very interesting point you made is that if there is 100 rupees of money in our economy in India, then around 15-16 rupees has come from the central bank.
Yes.
The rest of it is created by the commercial banking.
Currently, it is about 17, 18, but yeah, broadly.
So broadly in that 15 to 20 rupee range, let's say, one-fifth to 1/6 is what is being created by the central bank. The rest of it, the other 80 rupees comes from the commercial banking space.
Yes.
So actually the big drivers of money multipliers or money creation in the economy are actually the commercial banks.
Correct.
So that's kind of item number one. Item number two, which I think we've discussed many times earlier, is this notion that for the economy to grow, there has to be enough money. And if the money supply falls for some reason, it will at some point in time start constraining the growth of the economy as well. Now, couple of follow-on questions and we'll go to the second myth as well. So one is, how does the central bank create money?
So the central bank is also a bank.
Yes.
So it has a balance sheet. So there are assets and there are liabilities. So currency in circulation is a liability. There are many liabilities that it holds on its balance sheet. So the size of the central bank balance sheet is, in a way, how much money has been injected by the central bank. I mean, there are other elements there, but the central bank can inject money either through purchase of FX or buying government bonds. So whenever the central bank feels that more money needs to be injected, it will buy dollars and sell rupees, or it will buy Government of India bonds. So what happens then is that the Reserve Bank on the asset side gets those Government of India bonds or the dollars or euros or whatever, FX, foreign currency, and on the liability side then it has issued more money. And so the thing about being the king or part of the king, so seigniorage rights have been transferred by the Government of India to RBI, so it can do it whichever it wants. So that is how they inject money. The point at which they inject money, or meaning that how is it? So this is called what I call high-powered money. That when the RBI injects it, then the commercial banks then multiply it. For every rupee that RBI injects, potentially the economy gets 5.5 rupees.
We'll move on to the second myth. There are a number of follow-on questions, Neelkanth, but let's move to the second myth and then we'll come back to this. So second myth is that Indians are increasingly investing in non-banking financial assets, equities, mutual funds, etc., 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 and deposits are falling because of this. So can you elaborate and throw some light on this?
Deposits don't fall because there's no, that doesn't happen. So suppose I want to buy units of a mutual fund.
Yeah.
When I transfer it to say Axis Mutual Fund, it goes into Axis Mutual Fund's bank account.
Yep.
It's not going into the ether.
Yep.
And that is very much part of the banking system.
Yep.
If Axis Mutual Fund uses that to buy some units of stock A, it transfers that into the accounts of the person from whom they are buying stock A. So that goes into the bank account of another person. So irrespective of how the household decides to put money into something, the money stays in the banking system. So I think this is, you rightly said, is a myth that if people are investing in stock markets, it's taking money out of the banking system. I don't think that's the way it works.
It's a very important point, Neelkanth, because again, I think it is very, unconventional, this thinking, right? So just to clarify, I go back to our simplistic example: one economy, two people, you and I, and that's it, right? Now you have 10,000 in your savings account. I have 10,000 rupees in my savings account. You decided you now say that, boss, bank is not giving good returns. I am going to buy equity. So you buy 5,000 rupees of Infosys shares, let's say. So your savings account actually fell from 10,000 to 5,000, but that's only half the transaction. Because if you have to buy the Infosys share, you have to buy it from someone. That someone likely is me. So I am selling Infosys share to you, and so from the 5,000 rupees from your bank account has come to my
Exactly.
bank account, and hence the system-wide kind of deposits is still 20,000 rupees.
Correct.
And that has not changed. Now you can make it more and more complicated that, let's say you're buying not a share but you're buying a mutual fund, and or maybe you're buying a share and the counterparty is not an individual, it's a fund or it's a hedge fund or whatever. So the money may move from a savings account to a current account. It may move from a current account to a fixed deposit. It may move from a retail account to a corporate account. All of this could happen. The color of the deposit changes, but the total amount of deposit remains the same.
Exactly.
And so money can't be pulled out of the banking system through this. There are other ways in which money can be pulled out.
Yeah, exactly.
But through investing and so on and so forth, it can't be pulled out. Actually, buying a stock is no different from buying a car or buying a mobile phone. It's just a transaction from one account to another.
Absolutely.
Absolute. So I think this is another kind of concept great to clarify. Thanks for doing that. Let's push this a little bit, and then I'll come to some of the more relevant questions towards for today's environment. What happens if an FII sells equity and takes money out?
So it's not just relevant for what FIIs are doing, right? So what matters is, so think about India as a black box. And because the Reserve Bank of India is only arbiter of, so it's standing at the gate. It's almost like a toll collector. It's not collecting toll, but but it is standing there. So all the rupees and the dollars and all the exchange has to happen through that gate. So through that gate, on a given day, there are people transacting because they are importing, so they have to get dollars for that. There are people exporting, so they're earning dollars from that. There are foreign firms, foreign direct investment starting to invest, portfolio investors, as you said, selling in, coming in or taking out money. And so on any given day, many of these things cancel out. So what you may see is that foreign portfolio investors, suppose, take out $5 billion in a month, but it is quite possible that because some of our services exporters had a very good month, so
they bring in
money, or some foreign workers in Dubai or US are sending remittances to their families, and that $5 billion. So what matters is what's happening at the gate and what is the net balance, which is the balance of payments.
Right.
Now, if the balance of payments is positive,
which means more dollars are coming in.
More dollars are coming in. Then the RBI is effectively injecting rupees
liquidity into the system, because they are buying the dollars and selling rupees somewhere, and that rupees goes into the ecosystem.
Exactly, and the reverse is happening. So suppose balance of payments was like perfectly balanced, meaning there is no extra dollar coming in or going out, and then suddenly one foreign portfolio investor wakes up and says, "Oh, very expensive," or "I need the money. Give me $200 million or $1 billion." Now, suddenly we are short of $1 billion. So now the RBI, so what happens then at the system level is that the rupee supply also shrinks, right? Now, what the RBI can choose to do, and sometimes does do, when it tries to manage liquidity in the system, that it can counter that by buying bonds at the same time.
Right.
So if it sees that there is too much of leakage, basically, and this did happen, a couple of years back when a lot of dollars were stampeding out of the economy. So there was a very aggressive shrinkage of rupee supply, and then RBI starts to do open market operations and start buying bonds. Or, to complicate things a bit, it can do what is called a buy-sell swap.
Right.
Which then injects, so it can choose to buy dollars and sell dollars in the future. The future is most a commitment, so it doesn't affect the money supply, but because it's buying dollars from the market. So there are many ways in which the liquidity impact of this can be offset. But if this selling by the FPI results in a net deficit on the balance of payments, it shrinks money supply.
Thanks, Nilkant. So we've now covered the two myths. We'll move on to the current situation and try to explore a little bit what's happening. But before we dive in, I'll just go back to our episode on money and clarify one concept, because that will keep coming back again and again, which is the notion of different types of money, if I categorize it. So there is currency which is in circulation is one type of money. There is deposits in the bank, either in the savings account or current account, or even fixed deposits is a second type of money, which is liabilities of the banking system. And then there is money with the central bank, which is like, let's say, a third type of money. Uh, and so I remember you describing to us the difference between M0 and M3, which I guess are the two relevant concepts to talk about. M3 is currency in circulation plus liabilities of the central bank plus demand deposits, which is savings account, current accounts, plus fixed deposits, which is fixed deposits.
Correct.
And M0 is all the liabilities of the central bank. Is that?
Correct. Yes, that's correct.
Fantastic. And again, just for our clarity, when we talk of deposits, we talk of deposits with the banking system, which is one part of the money in the economy, because there is also
but that's a substantial part of
that's
money
a very substantial part actually of the overall thing.
So of about 260, 256, 257 trillion of M3 today, currency in circulation would be about 1/5 of that, so 45, 46 trillion.
Right. And the central bank anyway is not that much. So it is the vast majority actually is the banking deposits.
Correct.
So now, Neelkant, we spoke about how money comes into the system, which is either central bank brings it or commercial banks bring it. What are the ways in which money can go out of the system?
One way that money goes out of the system, and this is frictional meaning that it is temporary and reverses very quickly, is government cash balances.
Right.
So, so when the government collects tax or borrows through bonds, so issues a bond and gets the money, the government's bank accounts are not with commercial banks; they are with the RBI.
Right.
So, when the government is sitting on surplus cash, so suppose it has a plan to spend 50 lakh crores, 50 trillion rupees, in the process it is getting a flow of taxes which may be stronger than it expects or weaker than it expects, and there could be timing mismatches. So some project got delayed, payment is like 4 weeks late, so it could be sitting on say 2 lakh crores of deposits with the RBI. That is no longer there in the banking system.
Right.
So that is one way in which money goes out of the banking system. But that, as we discussed, is temporary, meaning that there is no incentive for the government to be sitting on a lot of cash.
Right.
Because it's very expensive, right? Because they're borrowing at 7%.
Correct.
And there's no point sitting on it earning zero. The second way in which money gets destroyed, and this is conceptually requires some attention, is when banks make profits.
Right.
So if you think of the bank's balance sheet, on the asset side are the loans and the bonds that we buy. On the liability side is deposits plus equity. So when banks make a lot of money, they make profits, and they don't distribute it as dividends, because banks issue dividends as well, based from their profits. So the undistributed profits add to their equity base.
Yep.
So if you think about it, if say 100 rupees was your asset side and 100 rupees was liability side, if say in a year your profit base goes up by, or say your undistributed equity or retained equity goes up by say 5 rupees, so 5 rupees has gone down from deposits.
Right. Because the balance sheet the liability side just rebalanced.
Yes.
Kind of 5 rupees moved from here, which is the deposit side, to the reserves and surplus and shareholders' equity.
Correct. So as that happens, in theory, money has been destroyed.
Yeah.
So what has also happened, this is part of the reason why we are seeing in this sort of this discrepancy in deposit creation, is also that at an aggregate level, the banking system, which used to make 1 to 2 trillion rupees, 1 to 2 lakh crores of profits at a system level, last year made 5 lakh crores of profits. And so what that does is that it has, and of course some are distributed as dividend, but the retained profits are substantial. The way to get it back into the system is for the banks to use that equity base, the expanded equity base, and and then give loans on the basis of that. That then creates deposits, and that money then comes back
Comes
into
back
the
in the
system.
system. Yeah.
Now, just to give you a perspective of where we are, compared to say FY8 and FY13, those were also periods where credit growth was very strong. Our tier 1 ratios, that's a form of capital buffers that we have, has gone from 9 and 10% respectively in FY8 and FY13 to 15%.
Right. It's gone up by 50% basically.
Yes. So there is a substantial amount of equity that the banks are sitting on. There is another measure which is CRAR, capital to risk assets, risk adjusted assets ratio, and so what you see is that what was 13% in those periods is now 17%.
Right.
So the banks have a lot of capital now, and therefore I think they can live with a much higher loan deposit ratio. So there is nothing sacrosanct or permanent about the 75%, 80% LDR that the system was used to at a certain point. Today, I think there's a scope for increasing the LDR thresholds without jeopardizing the safety and the liquidity of the banking system.
So just to kind of exemplify this, basically the tier 1 ratio or the CRAR, in a very, very simplistic way, is the ratio of the loans given as a proportion of the equity base of the company. Actually, it's the other way around, which is equity base as a proportion of the loans given out. So if a bank has, let's say, 10 rupees of equity, earlier it would have given out 100 rupees of loans, which is where the CRAR comes to 10%. Now against 10 rupees of equity, it is, or against 100 rupees of loans, they have 15 rupees of equity.
Yes.
And so they are not leveraging their equity as much as they used to earlier.
Correct.
And that is resulting in some kind of deposits going out of the system, because actually far more could have been created. It's almost like an opportunity cost of
exactly. So they could have been creating a lot more of money, which is currently not happening.
Not being created. So this is route 2, Nilkant. Route 1 was government kind of cash.
Yeah, and the
balances.
third way,
Route 2 was
great point. So let's to go back, recap. The first is when government cash flow, which is of course temporary. Even this equity base going up, because it's in the bank's interest, the bank shareholders' interest, to actually grow lending as much as possible in a safe way, and therefore keeping the tier 1 or the capital adequacy at a reasonable level, not excessively safe, in which case you're actually slowing down the economy, is also prudent. The third is when people take cash out of ATMs or tellers. So when currency in circulation goes up, deposits in the system come down, because and that's a parallel mode of circulation. So once there is if transactions start happening in cash all the time, then deposits in the system get drained out.
So cash in hand is not the liability of any commercial bank. It's actually the liability of the central bank.
Correct.
And hence it moves out of the bank's balance sheet and gets into it gets into central bank's balance sheet.
Correct.
So this is route 3 of
because if the whole economy in theory is just currency in circulation, there is no money multiplier.
There is no money multiplier. Yeah.
So while base money of the non-cash type is very potent, it can get a significant multiplier because of what the banks do. Currency in circulation has no multiplier.
Right.
So which is why. So as we think about why deposit growth in India has been so weak, this we can discard as a reason, because currency in circulation growth is actually way slower than nominal GDP.
Exactly.
So this is not the reason why deposit growth.
Understood. There's a fourth reason, Nilkant, which is hypothetical, which is that the commercial banks shrink their balance sheets, and
Yes. Yeah. So that can happen. There's this very funny meme that goes around where three friends are kind of exchanging credit, that
Right.
Yeah. You've seen that one, right?
Yeah,
so basically that, I owe you 100, he owes you 100, he owes you 100, and so then
money comes back to the same guy again.
Yeah. So no, the cash comes back, and then money in the system has gone down.
Right.
Because the credit has been settled, so the balance sheet has reduced.
Correct.
In real life, of course, those things don't happen so smoothly. But if the bank decides to shrink its balance sheet, I think money supply against
Right.
some stuff.
So Nilkant, we've laid the kind of, I would say, the groundwork for subsequent conversions, which is different types of money: money with central bank, money cash in hand, and deposits, and four ways in which money can move out of banking system into other forms. So now, what's happening? Why is deposit growth in India so sluggish, and for such a extended period of time?
So this has been for about 31 months now. So credit growth has been faster than deposit growth for 31 months now. And just to give you the context for this, we're not comparing apples to apples here because deposits are on a much larger base than credit. So it's not that 1% deposit growth is the same as 1% credit growth. So we need to keep that in mind. But be that as it may, this is the longest period of credit growth being faster than deposit growth since 2007-8. That time it had been growing for like 70, 80 months. The challenge is that the starting point for that 2003 to 2008 expansion in the loan deposit ratio. So as you can imagine, if credit growth is growing faster than deposit growth, the LDR, the loan deposit ratio, will keep climbing. The starting point for LDR in 2003-4 was 55%.
Right.
So therefore, 55 going to 80% was, or 75% required. I mean, we could sustain a much longer period of credit growth being faster than deposit growth. This has happened, I think, because the money injection, the implied money injection by the Reserve Bank, the central bank, was way slower.
Right.
Now, there are ways and ways of measuring that. The first is RBI itself publishes sources of M3, sources of money supply, and they show how much is from RBI, how much is from commercial banks.
Commercial banks.
So there is, and they also give that how much is because of FX purchases, how much is because of government lending, how much is because of commercial lending or lending to private corporates or private lending incrementally. So if you think about over a 12-month period, if say M3 growth by 100, how much has come from the Reserve Bank? That ratio for a long time has been in the 18 to 22% range. So that used to be very high. In the last 2 years, it is 14%.
Right.
While there are many issues, and we can discuss that on how exactly it works, and how it's actually unclear as to how exactly it works, but the observation is clearly that RBI in the last 24 months has been responsible for only about 14% of money creation, whereas it used to be in the 18 to 22% range. One can counter that there was a period in 21 and 22 when India was getting an excessive inflow of dollars because our imports had collapsed, our current account was actually in surplus for a few quarters, and capital inflows were happening at a very rapid clip. So the RBI had to do net buying of $170 billion. So they injected about 12 trillion rupees, 12 lakh crores, and this was in a way involuntary.
Right.
So there was a lot of overnight surplus, there's a lot of liquidity that was sloshing around the system. So they had to withdraw it at some point. So one way of thinking about it is that because there was a 1.5 year, 1 year period of excessive money printing, so then it required some draining out as well. But to calibrate on that, it is very important to see the stock then. So this was incremental flows. If you look at the stock, as we discussed right at the beginning of our conversation, the stock of money that has come from RBI in the 2003 to 2010 period used to be in the 20-22% range. Between 2014 and 2018, and remember that it was also a period which was where we were trying to fight high inflation, there was demonetization, there were lots of other disruptions that were happening. There it had fallen to a 16-18% range, and that was a period where the economy was very slow.
Right.
As a stock of money supply, at the bottom in this cycle, the RBI share had dropped to 17%.
Right.
So which suggests that the 14% incremental share was actually excessive, meaning that it did more than unwind just the excessive money printing of 2021. So I think that has been a root cause.
Right.
Some of it, and frankly, this is what we can see from the data. The rest of it has to be speculation on why the RBI may have chosen to do that,
Sure.
whether it happened accidentally, whether it was deliberate. One can guess that because there was significant macroeconomic uncertainty at a global level, because the Fed was keeping monetary conditions tight, it was doing quantitative tightening, it was raising interest rates, and as an emerging market, the last few times this has happened, there has been an attack on emerging market currencies. So the RBI may have been trying to keep liquidity conditions tight so that there was no attack on the currency, that it would, so that vulnerability on the currency side was reduced. But be that as it may, the reality is that because the base money injection was so low, all the incremental money, nearly all the incremental money was coming from credit creation by the banks. Now, beginning of this year, or maybe say I would say March, April or so, when the LDRs, you see after 30 months of this excess happening, the LDR started to reach new highs. They've actually hit new highs. Discomfort started, the regulators started feeling that because this creates vulnerability. See, one of the reasons why loan deposit ratios are important is that loans tend to be illiquid, deposits need to be very liquid.
Correct.
And if you keep LDR too high, there is a problem that if the depositors start asking for money at the same time, then their trust in the system could be violated. So which is why the regulators started to talk down LDRs and the banks were told to cap it out. I think that given that the banks are sitting on much higher levels of equity, and what is perhaps more important is the liquidity coverage ratio, and there are other ratios that you can work with. Perhaps the system can live with a higher LDR today than it would have sort of lived with, say, 15 years back. And so when the banks also started to bring down their LDR, the process of money creation completely stalled. So not only was the RBI trying to reduce the money it was injecting, the money created by the banks also started to slow, and therefore deposit growth slowed even further.
So Neelkant, I'll just stop you here because we've covered many concepts. So first, LDR, just to clarify, LDR is loan to deposit, which is total amount of loans in the system or for a bank. Let's say for Axis Bank, total amount of loans given by Axis Bank in the numerator divided by total deposits with Axis Bank in the denominator. That number, as you said, in the 2003 to 7 cycle started at 55% and went up. In this cycle, it actually started much higher, and it's now upwards of quote unquote comfort levels because of the slowness in the deposit creation. So this is one thing we spoke of. The second thing we spoke of is that we started the discussion by saying that if there is 100 rupees of money being printed, between 15 to 20 comes from the central bank, 80 comes from commercial banks. In this cycle, that number of the contribution of the central bank has gone down in the incremental, but also not just in the incremental, but also in the overall stock.
Correct.
And just to differentiate, incremental means new money being printed, overall stock means the total amount of money that exists. So RBI's contribution in the stock itself seems to have come down, which indicates that it was not just unwinding, there is kind of more than unwinding of excess liquidity that they brought in during the post-pandemic era. And so that seems to have triggered some of the sluggishness in deposit creation. Now I come to the next question, which you already kind of broached, which is if we have a LDR that we are targeting, and now the LDR has gone up because deposit creation is slow, a very kind of conventional wisdom again would be to say that let's slow down loan growth so that loan growth matches deposit growth. And you will see lots of articles talking about this, right? That system loan growth needs to come down to match deposit growth. But actually, if you go back, and you mentioned this point already, which is if the loan growth comes down, the deposit growth will come down even further.
Correct.
So the LDR likely will only kind of look worse, right?
Yes.
From what it is.
Yeah, so it will not come down as fast, and if you try to bring down fast, then the economy completely slows down.
Right.
And so here, I think it is important to look at actually the process of money creation. See, so far we have looked at aggregates, we have looked at how things manifest, but we have not looked at the process.
Right.
And I think the process in economic theory, I mean, we did a lot of research on this, went through various central banks commentary on it, because these are somewhat arcane issues. I mean, it's not a lot of discussion that happens routinely on this. And what we found is that there are two schools of thought on what happens to money supply. One school of thought is that the economy creates the money that it needs.
Right.
And so the economist way of saying it is money supply is endogenous.
Right.
And so that you just define the cost of money, and the economy kind of creates the money that it needs. Meaning that at some point the banks will ask the central bank for more liquidity, because overnight there will be some whatever asks, and the central bank is forced to print money and to keep the liquidity at a certain level. Because so the central bank, just to give you some background, has a liquidity management framework.
Right.
Because these are operational issues which cannot be dealt with you cannot have someone taking a decision on a daily basis, ad hoc, right? So you have to have a framework. There are guidelines as to where should the liquidity be overnight.
Right.
And there have been revisions. So starting with 99, there was an ILAF, and there was an LAF in 2004, 2009, 14, 19, 20. So there have been revisions to the liquidity management framework. There are strict guidelines. In that guidelines, if you go by that move, I think the RBI has met the liquidity management framework guidelines. So it's not that they have not, that they have violated that, and that is why money supply is in shortage. But there is another school of thought which says that, which we discussed earlier, that the central bank creates base money, and then the commercial banks apply a multiplier through lending. So if there is a shortage of base money, then the commercial banks, even despite the multiplier, cannot create more, and therefore the economy is short of money supply. Theoretical textbooks, because there is a lack of clarity on how exactly this happens, they bring it to something which reminded me of the Heisenberg uncertainty principle. If you remember the physics, that the momentum and the location cannot be with sufficient accuracy.
Yeah.
So the uncertainty in location and uncertainty in momentum is a constant,
Yes.
the Heisenberg constant.
Yes.
Now, it reminded me of that you cannot control the cost of money and the quantity of money both accurately at the same time.
Right.
That's what economics textbooks that I've seen measure, which I think makes a lot of sense. Because if you have excessive amount of quantity of money, your cost of money will fall, or and vice versa. But there is no clarity on how exactly the central bank, at what point can the central bank inject money. So it is quite possible that the current cost of money is too high, meaning that the interest rates are too high. One way of looking at it is that the wholesale price index, which has been negative for a year, and now it's now at 2%, it's very low. But if the average cost of borrowing for a corporate, a decently rated corporate, is say 8-9%, we're talking about significantly large real interest rates, and therefore the demand for credit is much smaller.
Right.
And because the demand for credit is smaller, there's not enough money being created. So maybe the solution is to cut rates. But at the same time, what we are seeing in the markets now is that in the overnight liquidity has now gone into surplus. So the overnight liquidity has been in surplus since about end of June. And given how long this has been in surplus, it is very clear that this is deliberate. It is not accidental. It is not because suddenly government started spending, which has also started to happen. Government cash balances have gone down. But, if the RBI wanted to, they could have sucked it out. So we are seeing now significant amounts of surplus in the overnight markets, what I think the RBI is signaling to the commercial banks is that, look, I'm going to keep it in surplus, and therefore you can go ahead and start growing your credit again. Now, given how tight the liquidity was kept for about 1.5 years, I think the banks are still wary that this could be temporary. So, despite the fact that the overnight rates have fallen to 6.25, as you know, in the overnight liquidity, I mean, this is there is a corridor. There is the repo rate at 6.5, there is the reverse repo at 6.25, and there is an MSF at 675, right? So 25 both said. The objective of liquidity management is to keep the overnight rates close to 6.5.
Right.
In the last 2 months, they are actually closer to 6.25. So the RBI, I mean, I think is signaling very strongly, in my view, that they're going to keep it quite relaxed on the liquidity side. This is not, so this overnight drop in cost of funding has not yet reflected in the 3-month and 12-month borrowing rates for banks coming down as much. So it is when that starts to happen that you will start seeing more demand, and therefore banks become comfortable lending again, and money creation, then the engine restarts.
Right.
If the banks still don't get the message, meaning the RBI's actions don't convey the message, then perhaps there will be a need to communicate it more explicitly.
Right.
So there is something called CRR, which the cash reserve ratio, which even between 2015 and 19, the last period where the RBI was tightening monetary conditions, was actually 4%. Today it is 4.5%. It was bumped up from 4 to 4.5 in that period where the RBI was trying to draw down liquidity. So maybe as this happens, there could be another 1 lakh crores of high-powered money, 1 trillion rupee of high-powered money that comes in, and then money creation can start again.
Right. Again, Nilkant, we covered a very vast range of topics. Just to kind of put it in my own words, 2 sources of money creation: central bank and commercial bank creation.
Yes.
Central bank money creation has been lower, but to your point, how money gets created is not. It definitely is not mathematical. It's not like you can press 4 buttons and suddenly money comes out.
Yes.
It's a function of how much money the central bank is creating, but also the multiplier itself. The multiplier is 5.3, 5.4. It can become 5.6, 5.7. It could go down to 5.1, 5.2. How that happens is fairly complex. It is based on signaling from the central bank. It is based on the interest rate, so if there is demand or not demand. It is also based on what the banks themselves, how they are feeling. If they believe that we are getting into a positive cycle and credit is going to be very good and so on and so forth, then maybe they are more positive lend. If they are in the mindset saying, look, I see a credit cycle coming and NPS may go up, then they may not so much, right? Or if the pressure on from shareholders is to say that keep liquidity buffer or keep capital buffer, then maybe they will not. So this is not, you can't mathematically frame this. There are a bunch of things that go into it. It feels like right now those bunch of things have not resulted in lots of credit creation and hence money creation. What you haven't explicitly said, but I think you implied, and maybe we should go there as well, is that this is resulting in macroeconomic implications, which is the growth of the economy is
it's starting to slow. So that's absolutely the concern, right? So there was a period from 2023 January onwards when the last wave sort of ended, and base effect was also gone, and we started. So there was debate whether India would grow at 5% or 5.5%. So those were the range, because we had slowed to 6.5%. The fear was that there would, because of scarring, we would grow even slower. That 5.5% range became 7.5% over the next 1.5 years. Now people were starting to extrapolate it to 8%, that we can actually see, and frankly, before that could happen, in the last 3-4 months, so starting, I would say, March, April, around the time, if you remember, that LDR sort of capping started to happen, we've seen that the economy has lost momentum. So you can see that in weak cement demand growth, you can see that in weak car sales growth, weak power demand, the ordering momentum for some of the industrial goods. So there are several signs that the economy is starting to slow down. Now, this is not the only factor. So I think I'm glad that you brought up the factor that there are many things that are going into it. What has also happened is that because during the election the government machinery was stalled, in the first 4 months of this fiscal year, only about 17% of the fiscal deficit has been incurred.
Right.
In the previous year, it was more than 40% in the first 4 months. So,
Right.
when you add, this is the central government, but if you add the problems at the state government, because state government machinery also was involved in elections, the fiscal impulse. So what we call fiscal impulse is the change in the fiscal deficit. So if you take 12 months of fiscal deficit in the last 12 months and compare it to what was there in the previous 12 months, that gap is minus 3% of GDP. So there is a very strong negative fiscal impulse, fiscal drag, let's say, because of the election-related things, and which I think will recover. I think the contracting pace has already started picking up, and I think expenditure will also start picking up in the next couple of months. By Jan, Feb, March, I think that should be sorted out. But at the same time, we need to also, in order to sort of reduce the headwinds to the economy, also start to sort of address the monetary side of the issue. So as aggregate demand picks up, because the government's spending engine will be restarting, I expect that some credit creation and all of that starts to happen as well, because nothing is direct. So when we explain some of these things to even investors, in macroeconomics, everything kind of is connected.
Yep.
So what happens is that you have that if the government spends, the person who benefits from it then feels emboldened to buy a car or buy something else, and then that creates a multiplier effect, and the flow happens. So getting that restarted is of course very important, but at the same time I think the excessively tight monetary conditions also need redressal. And what is encouraging is that in the last 2 months, 2.5 months, the RBI is clearly signaling that it is.
So I'll come to this part now, Nilkant, and will be helpful just to kind of explain this even further. You said that RBI is keeping liquidity in excess surplus, and the expectation is that because RBI is keeping liquidity in surplus, banks will pick up the queue and they will start to lend more. So first is, what does keeping liquidity in surplus mean?
What is overnight liquidity? Let's start with that. So in the banking system, there is a requirement, there is a cash reserve ratio. So if you're a commercial bank, you have to keep a certain amount of cash with the RBI every day.
Right.
This is just so that at some point, if all your depositors start demanding their deposits back, then you have sufficient liquidity to pay it back. So there is no risk with the banking system. Now, in order to deposit that, because see, as we know, in banks there are several timing issues. So some loans are given for 3 years, some loans are given for 5 years, for 10 years. Well, 10 years is not possible, but say buy a bond for 10 years. On any given day, some loan could be getting repaid, some new loans getting issued, some deposit getting matured. So on a daily basis, the bank has to make sure that at least 4.5% of its, they call it NDTL, net demand and time liabilities, are kept with the central bank. So in order to do that, a bank can borrow from other banks. So there's a call money market. So every night, you kind of say, this much liquidity I need to post. Can you borrow? Someone would have excess, someone would have deficit, so that happens. If that market is not that functional, so then you can go and tell the RBI that, look, I have so many government bonds in the repo market, so against this, can you lend money to me? That is how interest rate transmission also happens, because in order to, so the bank knows that if I need to, at the last resort, go to the RBI, I will get money at 6.5, which is the repo rate. Now, if I need to deposit money to the RBI, I will only get 6.25, which is the reverse repo rate. Now, so all of this overnight liquidity is in order to meet that 4.5% CRR requirement, because that you wanted to post. And now from that starts the rate setting process and transmission process. Now, if you're marginally in deficit, so this is what the liquidity management frameworks have recommended in 2019, for example, that keep the liquidity in slight deficit of 0.25 to 0.5% of NDTL. Now, these are not, as you mentioned, these are not like laws of nature or,
Yeah.
not scientific. There's from experience, and it's also not completely arbitrary. These are very experienced people who've looked at this for a very long time, looked at global benchmarks, and have come up with something. And so this 0.25 to 0.5%. So if it is there is marginal liquidity deficit, the assumption is that when the bank is looking at how much it needs to lend, how much liquidity it needs to hold, if it is in marginal deficit, then the actual marginal cost of borrowing is the RBI's repo rate.
Right.
And then the interest rate environment sort of gets set. Now, by keeping liquidity in significant surplus, so 1.5 to 2.5 lakh crores of surplus, the overnight rate has now gone down to 6.25. So effectively, that's a signal that overnight rates have fallen, so the banks should be much more comfortable giving out loans. The problem is that they don't trust that this is going to last.
Sure.
And it is only when that trust builds up that
They will kind of transmit.
that they will be able to borrow money at, say, whatever, for 3 months or 12 months for short-term loans also, and then be able to lend out at lower rates.
Right. So just to again simplify this, liquidity deficit means that actually banks are borrowing from the RBI, and liquidity surplus means that banks are actually keeping money with the
Correct.
RBI.
Yes.
And hence, if banks are borrowing money from the RBI, they are borrowing at 6.5%, which is why the overnight rate is 6.5.
Correct.
When banks are giving money to RBI, the rate is at 6.25 because that's what the RBI gives them. And now, not all banks are always borrowing and all banks are always lending. So this rate could also be somewhere in between,
Yes.
depending on how the system is kind of kept. And what the RBI does is it will either, as you said, buy government bonds or sell government bonds, looking at this situation so that the rate either goes to either banks are they would like majority banks to borrow or to kind of deposit money with them.
Yes.
That's how they manage the liquidity in an overnight basis. The theory is that if they manage that, it will subsequently, flow down. So conceptually, again, if banks are keeping money with the RBI at 6.25, the bank, and for a long period of time, the bank management will say, why am I keeping money at 6.25? I can lend it at 9%
Exactly.
or 10%.
Exactly.
It's economically more profitable. So let me go out and lend.
Yes.
And because of that, banks lend more, and that's how the money creation happens. What, according to you, is happening right now is that while the liquidity is in surplus, the bank management is saying, look, it is in surplus, but I don't believe it will be in surplus forever. So let's wait and watch. And so this kind of, they need to get the confidence that actually that's the signal.
Because when you give a loan, it is not for 7 days.
It's not for 3 days, it's not for 5 days.
Or 5
yeah.
days or 14 days, right? So
it is for a 3 years or sometimes
or
5
even
years.
if 6 months,
Yeah.
you need to have the comfort that you
Yep.
will get that. And this is where the debate or the lack of clarity on how money creation happens comes up as well, in the sense that so the RBI has done, so in addition to the 2.11 lakh crores of dividend that it paid the government, it has also does what is prescribed as a tool for liquidity injection, which is a buy-sell swap. Basically, that you buy dollars in the spot market and you sell
it in the forward
future.
market.
So on this, so their futures exposure is actually negative now. So it is in the last 4-5 months it has gone negative, and as we know, their foreign currency reserves have been going up. So now they're $685-690 billion. So they have deliberately done this. Now, the point is, all of this money is actually coming back to them in the overnight market. So then the question is, so kya fayda, right? So that you inject so much liquidity, but the banks don't know what to do with it.
Yeah.
So they are just giving it back in the reverse repo market,
Yeah.
right? But I think the solution, so this is where people say, what can RBI do? But as you mentioned, that if you keep it like that, then the banks feel tempted, boss, 0.25, 0.5% is a lot of money.
Yeah, absolutely.
Right? I mean, so with a net interest margin of 4%, imagine if you could get an extra 0.25%, your profits will go up 6%. Actually, if you take out if you think about it from a cost to income ratio and actually the return on assets, so the impact can be massive. So, over a period of time, this will result in the banks becoming much happier, and so then the money creation engine then kickstarts again.
And the RBI has many more tools. I mean, some of these tools are mathematical, or these are buttons, right? Like you put liquidity in surplus, etc. But they also have the power to influence and
Oh yeah, absolutely.
and so on and so forth, which could all again come together and change the situation. A fascinating conversation, Neelkant. Thanks a lot for taking time to talk about this. It's a very, very involved topic, and I think we can talk about this for hours. But we started from a couple of myths. Myth number one, that deposits create the loans, whereas we learned from you that actually it's the loans which create the deposits. And by the way, 5 to 6x of the central bank's money is actually created by commercial banks.
Correct.
So the main engine for creating money actually are the commercial banks, and they create it by giving out loans. So loans create the deposits, not the other way around. Myth number two, that just because people invest in equities or mutual funds or any other types of investments, deposits don't go out of the system. Deposits stay in the system. The color of the deposit may change, the name may change, the interest it gets may change.
Yes.
But the amount of deposit doesn't slow down. And so this is not a reason for the slowdown in deposits that we are seeing. And the third topic we spoke about is that if you think of the credit deposit ratio or the LDR, the loan deposit ratio, and if you want to target a certain level, and if the deposit growth is slowing, and if we try to kind of slow down the loan growth, it is unlikely to result in the outcomes we desire, because actually the deposit growth itself will slow down even further because money creation is getting hampered. So that's another topic we spoke about. We spoke about why deposit growth is lagging, where we learned from you that the central bank's component of money, both in the incremental as well as in the stock, has come down, and that seems to be a driver of this kind of deposit growth coming down. It is perhaps kept low because of inflation and other macroeconomic consideration, liquidity adjustment framework, as you said. So that is perhaps one driver. As well, banks have created enough equity against which they are not lending enough, and so their capital adequacy ratios, or the various CET1 ratio, etc. we spoke about, have gone up, and so there is buffer for them. So they have created less deposits than they could have created.
Yes.
And that's maybe another factor which is determining this slow growth in deposits. We discussed that actually how money gets created, frankly, it's not well understood. There are various theories, but at the end of the day, it's not well understood. And it is not a mathematical exercise. There are many things involved, including human emotions and what confidence and animal spirits and the like.
Yes.
What is definitely visible is that the reduction in money supply seems to be one of the factors that is impacting growth. There are other factors, but one of the factors that's impacting growth seems to be the reduction in money supply. And hence, we are also seeing the central bank now moving to a liquidity, surplus situation as a way to signal that they would like the money creation to go up. And in your view, if banks don't take the bait, there could be more steps that could come subsequently.
Yes.
Great conversation, Neelkant. Thanks a lot for sharing, and I hope you enjoyed the conversation as much as I did.
I did. Thank you. Thank you for having me.
Thank you for listening into this episode of Open Dialogue. I hope you enjoyed this as much as we've enjoyed bringing it to you. We are overwhelmed by the response that we've received and really look forward to your comments and feedback. Do like and subscribe to our channel to keep track of new episodes that are coming through. Thank you.